Stocks versus bonds. What's the difference between them, and what do you need to know before you invest in either? Stocks represent shares in a company. By owning some stocks, by buying stocks, you're becoming a shareholder. You're owning a part of that company. Bonds are a form of debt. They are issued by companies or governments in order to raise money to finance their operations or their expansion plans. They represent a promise by the issuer, that government or that company, to pay bondholders a certain amount, a certain interest rate, at a certain time. Stocks are publicly traded on stock exchanges around the world. They are bought and sold every day, and that can result in some volatility in their prices. Bonds, however, are not traded in the same way, and that's why stocks are generally perceived as being a riskier assets and bonds are being perceived as safer assets. But even bonds have varying degrees of risks. Bonds issued by the US government, which are known as treasuries, are considered relatively low risk, and that's because of faith in the US government that it will never default on paying its bondholders. Another difference is dividends. Stocks will generally pay dividends if the company is performing well. This means that at the end of each year, on top of the money you're making trading that stock, the company might give you a little bit of extra cash called dividends. Bonds, however, don't pay dividends. Regardless of which asset class you're investing in, be sure to do your research on the company or the government that you're buying into, and be sure to diversify your portfolio. Happy trading. This is Investing Explained.